Welcome to the debate. Today we are standing at the foot of a mountain that casts a shadow over the entire global economy. We're attempting to wrap our arms around an entity so massive that it almost defies traditional categorization. We are talking about Blackstone Inc. As of September 2025, this firm manages $1.2 trillion in assets. To give you a mental model for that scale, if Blackstone were a country, its GDP would rival Spain or Indonesia. They're the landlord to the world, the logistics network for your packages, the owner of your genetic history through Ancestry.com, and the financier behind the AI revolution.
It's a staggering concentration of influence. And, I think it's just impossible to have this conversation here in February 2026 without acknowledging the atmosphere we're operating in. We're less than a year removed from the tragedy at their Manhattan headquarters in July 2025. The loss of 4 lives, including Senior Managing Director Wesley Lepotner, casts a very long, very somber shadow over this discussion. It was a horrific event that I think pulled back the curtain on the intense, high-pressure stakes at the absolute center of the financial universe.
It was a tragedy that shook the entire industry. But, and this is crucial to our analysis today, it also demonstrated the sheer institutional permanence of the firm. Despite the shock, the machinery of capital allocation, it didn't stop. And that brings us to the central tension we need to resolve today. Is Blackstone the ultimate engine of economic efficiency? A necessary force that stabilizes housing, saves distressed companies, and builds the infrastructure the future needs? Or is it, as you've argued in the past, a systemic risk? A force that commodifies human necessities and extracts value while society bears the cost?
I think framing it as efficiency is a euphemism. I view Blackstone as the apex predator of hyper-financialization. When an entity controls $1.2 trillion, the line between investor and market manipulator just evaporates. My position is that Blackstone represents a model where the drive for yield leads directly to ethical failures, from child labor in their portfolio companies to the distortion of housing markets. They privatize the massive gains, but the risks are socialized. They land on the workers, the tenants, and the public.
I understand why that narrative takes hold. It's a popular one in the media. But I believe it fundamentally misunderstands the function of private equity. Blackstone is, it's a masterpiece of modern finance because it enters voids where traditional banks and governments cannot or will not go. They deliver the returns that pension funds, firefighters, teachers, public servants rely on to stay solvent. They drive innovation in real estate and technology. They don't just extract, they optimize. They create value in chaos.
Value creation is the slogan on the website. But we need to look at the methodology. Because the origin story is often told as a hero's journey, but the mechanics of how they got here, they tell a very different story about how that value is actually created.
The origin story is actually the best evidence of their competence. You have Steven Schwartzman and Peter Peterson leaving Lehman Brothers in 1985. They didn't start with an empire, they started with $400,000. In today's money, that's barely over $1 million. It was a shoestring operation. Their insight, and this is the key takeaway for anyone trying to understand their dominance, was realizing that advisory work wasn't enough. They were originally just giving advice on mergers, but after the 1987 crash, they realized that to really control the outcome, they needed skin in the game. They needed to move from being advisors to being owners.
Skin in the game sounds noble, but let's translate that into what actually happens. Moving into a merchant banking and private equity model meant they could take control of companies, strip them of their assets, load them with debt to pay themselves dividends, and then sell them off. They survived the 1987 crash and the 2008 crisis, not just because they were smart, but because the model is, by its nature, designed to be extractive. They buy a company, squeeze the lemon until it's dry, and then toss the rind.
See, you're describing the classic corporate raider stereotype of the 1980s, which is, frankly, it's a caricature of the Blackstone we see today. The core thesis is buy it, fix it, sell it. The fix it part is where the work happens. Look at the Hilton Hotels deal in 2007. This was a $26 billion leveraged buyout at the absolute peak of the market. When the 2008 crash hit, everyone said Blackstone would go bust. They said Hilton was dead. But Blackstone didn't strip it. They restructured the debt, they improved operations, they expanded the brand globally. By the time they took it public again, they had made a profit of $14 billion. That isn't asset stripping. That is operational excellence.
Hilton is the success story they put on the brochure. I'll give you that. It was a home run. But we have to look at the failures to understand the systemic risk. Let's talk about Southern Cross Healthcare in the UK. This is a textbook example of financial engineering gone wrong. Blackstone bought this nursing home operator. They then executed a strategy called OpCo-PropCo. And for the listeners who aren't finance majors, we need to break that down because it's the secret sauce of extraction.
It is a standard real estate strategy. You separate the operating company from the property company. It unlocks value in the real estate.
They sold off the actual buildings, the real estate assets, to realize immediate profit. Blackstone pockets that cash. Then the nursing home business, the OpCo, had to pay rent to use the buildings it used to own. When the economy turned, Southern Cross was crushed by these unsustainable rent burdens. The company collapsed in 2011. 31,000 elderly residents were left in limbo, unsure if they would have a bed to sleep in. Blackstone had already exited the investment by then, claiming they left it in good shape. But they set the timer on the bomb. That is the difference between optimization and extraction.
Southern Cross was a complex failure with plenty of blame to go around, including subsequent management decisions made long after Blackstone left. But you're focusing on a single deal from, 15 years ago? To understand Blackstone's impact today, in 2026, you have to look at real estate. It's their largest asset class. And the narrative there isn't about traps, it's about spotting macro trends before anyone else.
Or cornering markets so effectively that you dictate the price.
Let's look at the facts. After the subprime crisis in 2008, the U.S. housing market was radioactive. Banks wouldn't lend, builders wouldn't build. Blackstone stepped in and bought $5.5 billion worth of single-family homes. They provided a floor for the market. They stabilized neighborhoods that were being hollowed out by foreclosure. If they hadn't stepped in with that capital, the recovery would have taken a decade longer.
I simply don't buy the white knight narrative on housing. They didn't stabilize neighborhoods for the families, they stabilized asset prices for their investors. By purchasing single-family homes on that scale, an industrial scale, they fundamentally changed the nature of housing. They turned it from a place where families build equity into a financial asset class for global capital. They created a permanent renter class. And look what happened in Frederiksberg, Denmark in 2019. Blackstone's partners started buying up apartments, and the backlash was immediate. The locals realized that the renovations were just a pretext to jack up rents and displace long-term tenants. The public outcry was so severe they had to withdraw. People don't want their homes optimized by a private equity firm.
Denmark has a very specific regulatory environment, and Blackstone pivoted. That is the sign of a smart allocator. They didn't just sit on housing. They saw the e-commerce wave coming before the pandemic. They built Link Logistics by acquiring GLP's U.S. portfolio for $18.7 billion. They essentially own the physical backbone of the internet, the warehouses where your goods sit. And now, they're doubling down on AI. The acquisition of QTS Realty Trust for $10 billion in 2021, and the massive deal for AirTrunk in Asia Pacific in September 2024 for over $16 billion US. This isn't rent-seeking. This is capital-intensive infrastructure building. Who else has the dry powder, the cash on hand to build the data centers the modern world runs on?
The infrastructure argument is your strongest point. I will grant you that. Without the data centers, the AI boom stalls. But we need to talk about the stability of the vehicles holding these assets. You mentioned their resilience, but we saw cracks in late 2022 with the Blackstone Real Estate Investment Trust.
A $125 billion fund? The flagship?
Exactly. And what happened? On December 1, 2022, they had to restrict withdrawals. They gated the fund. Too many investors wanted their money back at the same time. This reveals a fundamental liquidity mismatch. They're marketing these funds to wealthy individuals as stable semi-liquid investments, but the underlying assets, warehouses, hotels, data centers, are illiquid. You can't sell a casino or a warehouse complex overnight. When you slam the gates shut, it shatters the illusion of stability. It tells the market, you can check in, but you can't check out.
I completely disagree with that characterization. The gating mechanism is a feature, not a bug. It's a safety valve designed precisely for those moments. If Blackstone were forced to sell premium assets like the Bellagio in Las Vegas or those QTS data centers in a fire sale just to meet a temporary panic in redemption requests, that would destroy value for the investors who stayed. By restricting withdrawals, they preserved the integrity of the portfolio. And look at the result. They navigated the storm, they're back on offense. Look at the Soho retail deal in November 2024, buying 4 buildings for $200 million. They're betting on a retail resurgence when everyone else is scared. That is the definition of a contrarian value investor. They didn't buckle, they doubled down.
They are contrarian, certainly. But my concern is always the human collateral of this efficiency. We have to discuss the operational realities inside the companies they own. When the mandate from headquarters is maximize yield, safety and ethics often get cut from the budget. We cannot have this debate without talking about Packer Sanitation Services, Inc., or PSSI.
I suspected you would bring this up. It is a dark mark, admittedly.
It's more than a dark mark. It's a moral failure. PSSI is a slaughterhouse cleaning firm owned by Blackstone. An investigation by the U.S. Department of Labor found more than 100 children, minors, some as young as 13, working illegally in these facilities. They were working overnight shifts with caustic chemicals, suffering chemical burns. This wasn't one rogue manager. This was systemic enough that PSSI paid a $1.5 million fine.
It was a horrific situation. There is no defending child labor. But we have to be precise about liability and intent. Blackstone owns hundreds of companies. They are not making the shift schedules in a slaughterhouse in Grand Island, Nebraska. They aren't hiring the janitorial staff. When this came to light, they acted decisively. They paid the fines, they fired local management, and they implemented zero-tolerance compliance measures.
But that is the investment thesis. The thesis is aggressive cost-cutting. When you demand 20% returns from a low-margin, dirty business like industrial cleaning, you create an environment where managers feel forced to cut corners to hit their numbers. It's the same pattern we saw with Motel 6 in 2018. That chain was owned by Blackstone. They were caught providing guest lists to ICE, Immigration and Customs Enforcement without warrants. They turned their own hotels into a dragnet for deportation. They settled for $19.6 million. These aren't glitches. These are the predictable outcomes of a culture that prioritizes the extraction of data and value over human rights.
I think you're connecting dots that don't necessarily form a line. The Motel 6 issue was a specific failure of policy that was corrected. But if you want to judge the portfolio by its social impact, you have to look at the other side of the ledger. You can't just cherry-pick PSSI and ignore Spanx.
Spanx?
Yes. In October 2021, Blackstone took a majority stake in Spanx, valuing it at $1.2 billion. But here's the nuance. The deal was prepared by an all-female investment team from Blackstone, and they installed an all-female board of directors. That is progressive corporate governance in action. Or look at the energy transition. You mentioned environmental concerns, but Blackstone is one of the largest investors in green energy. In 2022, they made a $14 billion deal with Emerson Electric for climate technologies. They're pouring billions into the grid updates required to decarbonize. You can't ignore the billions flowing into climate solutions just to focus on the operational failures of a cleaning company.
I'm not ignoring them, but I am questioning the accumulation of power that allows them to play both sides. And that brings us to the most, dystopian element of their portfolio, data. In 2020, Blackstone acquired Ancestry.com for $4.7 billion.
It was a consumer technology play. It's a subscription business with high retention. It's a cash cow.
It's a genetic database. This gives a private equity firm, an entity designed to maximize profit above all else, access to the DNA of millions of people. There are ongoing class action lawsuits regarding genetic privacy. When you combine that with their history in security technology, like the acquisition of Vivint, or educational software like Cvent, you start to see a picture of an entity that knows your biology, your movement, and your behavior.
I think that's a leap into science fiction. Ancestry is about family trees, not surveillance. Blackstone bought it for the same reason they invested in Bumble, the dating app, or Oatly, the oat milk brand. They're chasing consumer trends. The genetic data is subject to strict privacy laws. Blackstone is a financial fiduciary. They're not in the business of selling DNA to the highest bidder. That would destroy the value of the asset. They're in the business of generating cash flow, not building a police state.
But they are unregulated in a way that traditional banks are not. And the scope is widening. They're moving heavily into credit and insurance. Look at the deal with AIG in 2021 to manage a huge chunk of their life and retirement portfolio. That's a $2.2 billion investment for a nearly 10% stake. They're becoming a complete financial ecosystem. If they fail or if their algorithms get it wrong, it's not just a bad quarter for shareholders. It's retirement funds, it's housing markets, it's life insurance policies.
And that is exactly why their scale is an asset, not a liability. In a volatile world, you need large, well-capitalized players who can absorb shocks. Look at the financial results for 2024. Revenue was $13.23 billion. Net income was $2.44 billion. They have nearly 5,000 employees managing over $1 trillion. That is incredible efficiency. Even after the shooting in July 2025, a moment of profound institutional trauma, the firm demonstrated resilience. They continued to operate. They completed the acquisition of Warehouse REIT in the UK just 2 months later in September 2025. This engine doesn't stop, and that reliability is what pension funds depend on.
That engine doesn't stop, but it consumes everything in its path. You mentioned the UK acquisition. They're also buying airports now. A 22% stake in AGS Airports in March 2025. They're buying holiday resorts like Butlins and Hamilton Island. They're buying sandwich shops like Jersey Mike's. As they grow, the accountability dilutes. When you own everything, you are responsible for everything. But somehow when things go wrong, like at PSSI or Southern Cross, it's never the parent company's fault. It is a structure designed to immunize the capital from the consequences of its own demands.
It's not about avoiding fault. It's about managing complexity. No organization with $1 trillion footprint is going to be free of operational challenges. The question is the net impact positive? I argue yes. They saved Hilton. They are building the data centers that will host the future of computing. They provided liquidity to the housing market when banks were paralyzed. Without that capital, the economy stagnates.
And I argue that the net impact is a distortion of what markets should be. Housing should be for living, not a yield vehicle for a REIT. Healthcare should be for healing, not for sale-leaseback schemes. The alternative investment model creates a layer of abstraction between the owner and the consequence.
I see your point about abstraction, but without that capital, many of these industries would simply collapse or fail to modernize. The financialization you fear is often just the modernization of capital structures.
I suppose that is where we fundamentally disagree. I see a structure that incentivizes short-term gain over long-term social health. We can marvel at the $43.5 billion in total assets on their own balance sheet or the trillions they manage for others. But the cost of that wealth is the erosion of public accountability. Whether it's pricing people out of homes or compromising privacy, the model externalizes risks to society.
And I would argue that with great scale comes complex challenges, certainly, but capital allocation is a necessary function of a complex global economy. Blackstone provides the returns that secure retirements. It identifies undervalued assets and improves them. It is a necessary engine.
As Blackstone continues to grow, acquiring everything from Jersey Mike's to Australian islands, the line between financial firm and global power isn't just blurring. It's practically gone.
And perhaps that is the reality of the 21st century economy. We are leaving it up to the listener to decide if that power is in safe hands.
Indeed. Thanks for listening to The Debate.
Until next time.